Hello everybody, welcome to part 2 of chapter 3. We have discussed many lot things, right? We discussed about inherent risk, control risk, detection risk, SA315 we understood the inception, the basics of SA315. We'll go through many more things in this chapter 3. It is a very important chapter and this forms a very important base for what is next that is going to come in chapter 4. So very much be careful, be attentive, stay hydrated. Let's go. Come on, chapter 3 part 2. Come on. Materiality we have studied in the previous classes also. What standard? SA 320 sir. SA 320 covers materiality. What is materiality? As I told you, materiality is that area or that part where if any misstatement occurs and it breaches that threshold, right, it affects the confidence of the stakeholders is what we told, right? There are misstatements and there is material misstatement. Why material misstatements, sir? Because material misstatements are those misstatements which decides whether a stakeholder confidence is affected or not affected. It influences. Stakeholder will take decisions because material misstatement, if it is there, automatically the stakeholder who is supposed to take a decision will now rethink to change his decision. These are all things that happens as part of materiality. Auditor must be very careful. So why materiality comes in first place? Because auditor will do audit and he gives what kind of an assurance? He gives reasonable assurance. He will not give absolute assurance. So reasonable assurance, what does it mean? It is a high level of assurance but not a full-fledged assurance. When it is not full-fledged assurance, he cannot vouch for each and every transaction or each and every line item, each and every presentation or disclosure. He can't give the assurance that it is true and fair. So what he does, for every financial statement, after he assesses the overall industry, overall entity and its environment, he comes up with a number. If that particular misstatement or particular misstatements overall financial statement level, if it breaches this particular number, this particular threshold, could be 1% of sales, 5% of profit before tax, anything for that matter, as per auditors, what judgment? Professional judgment, sir. So if that misstatement as an overall financial statement, if it breaches that number, then auditor will do further audit procedures and his opinion will also be changed. If it affects the financial statements as a whole and it is not giving a true and fair view, automatically auditor will give either a modified opinion or an opinion which could lead to an adverse state also, which is an adverse opinion. Right, there are so many things that are involved. Materiality is very important as far as audit procedures is concerned, because if a particular let's say sales, right, revenue, he puts a materiality, he puts a number. If there are no misstatements, if everything is fine, he says, okay, this particular testing, this particular revenue line item is fine. But what if he misses few things? What if those are not found out because the materiality either is too high or even that materiality is not sufficient enough for him to make sure that everything is fine? What if that those things happens? That is when auditor need to be very careful, sir. He has to give materiality at an overall financial statement level. Then again, after doing audit procedures at each assertion level, he needs to again reassess, okay, whether this is fine or not, basis the industry requirements, basis the statutory requirements, basis the client's exposure in the past. He needs to assess so many things. That is when there is something called performance materiality which will come, sir. Performance materiality will come, sir. So what is performance materiality? Sir, first you understood materiality. Materiality is that number which auditor after his professional judgment gives it, so that that number will act as a base or a benchmark. That number will act as a benchmark for auditor to assess or to understand whether the company's misstatements are materially misstated or not. Okay, sir. So misstatements including omissions are material if they individually or in aggregate could reasonably expected to influence the economic decisions of users taken on the financial statements. So materiality is not always a matter of relative size alone. A small amount lost due to fraudulent practices can indicate a serious flaw, because What is it triggering? It is not just that small piece of misstatement. It is an overall, process flaw. When it is there, auditor should enhance or exercise more audit procedures to get comfort over those process or those internal controls. A small lapse in internal control could indicate potential material misstatement, sir. Okay, it requires immediate attention of the auditor, which is or which could be material and which impacts the decision, and not just the stakeholders but the auditor's opinion as well, sir. Understood? Okay. Moving ahead. Sir, when does this materiality apply? Sir, according to SC 320, auditor's responsibility for materiality as far as it is concerned, it will be in 3 stages. When, sir? Planning stage. Obviously, planning stage you will understand overall entity and its environment. Then only you will be planning the audit. Sir, before planning, there is something called, which we read in chapter 2. What is it, sir? Audit strategy. Audit strategy also he needs to think. Audit strategy also he needs to consider few things as far as materiality is concerned. Because planning determines what? Nature, timing and extent of risk assessment procedures and further audit procedures. Further audit procedures are determined only when you are able to exercise your professional judgment and able to determine something called as materiality, sir. Then what? After planning, what you will do? You will perform, you will execute. So during the execution also you will have to revise or think about your materiality. If it requires a revision, you will revise your materiality. If it doesn't require your materiality to be revised, you will not revise. But you have to think or you have to re-perform your materiality calculation. So because when you are performing and when you are at the execution level, when you are at a functional level, automatically you will assess risk of material misstatement, right? When you are able to get those risk of material misstatement, automatically in a planning stage, you might not have thought about a particular assertion, particular area of business. You might not have thought, but during the execution flow, you got some evidence, some piece of evidence which is corroborating for the fact this could be a risk of material misstatement. Accordingly, you will revise your materiality. That is second, sir, which is performing. Third, evaluating. Evaluating what? Evaluate the effect of uncorrected misstatements. You have corrected, you have identified, you have given the management a chance to make sure these are the misstatements, these are the internal control lapses. Fine, that is fine. But there would be scenarios where the misstatements are not detected or uncorrected. So for what? For those kind of things, auditor has to reassess and accordingly has to modify his opinion or give an opinion which would corroborate to his evidence, which would be sufficient and appropriate. Without having sufficient and appropriate, how can he give an opinion, sir? Understood? Okay, fine. Now, determination of materiality. As I told, auditor will exercise what? Auditor will exercise professional judgment. You should have reasonable knowledge of business, economic activities and accounting. Understand that financial statements are prepared to levels of materiality. Right? Recognize uncertainties inherent in measurement, estimates and judgments. He has to take consideration of future potential events that could damage the going concern also. Those are few elements which auditor in practice has to understand and assess so that his materiality number will not go wrong. Okay, sir? Okay. Then make reasonable economic decisions on basis of financial statements, which is anyways the case. So we discussed about performance materiality. What is performance materiality? Now let's think of performance materiality as a safety net, sir. Okay, as a margin of safety. You know what is margin of safety? There is that extra precaution. We as an auditor, we are so much cautious. So we should exercise that caution during audit also. Let's say if materiality is 10 lakhs for a particular line item. What you are doing for performance materiality while calculating a particular assertion? You are giving 7.5 lakhs for performance materiality. So overall financial statement for a particular line item, that is 10 lakhs. Sorry, at overall financial statement level it is 10 lakhs, but at a particular line item you are saying it is 7.5 lakhs. So when the particular misstatement breaches 7.5 lakhs, you should indicate your management and you have to revise your audit plans and strategies so that further audit procedures are applied, because you are now more cautious, you are lowering your risk, because not all misstatements might cross your materiality level. So what you will do, you will give some additional number which is performance materiality, which is lower than the original materiality, which is at the overall financial statement level, sir. Okay, understood. So what is performance materiality? Here it sets lower than overall materiality, reduces risk that aggregate small errors add up to material amount, applied during field work or testing. Okay, materiality and audit risk are considered throughout the audit. Sir, audit risk, what is sir? Audit risk, risk of material misstatement into detection risk is audit risk. What is risk of material misstatement? Inherent risk into control risk. Inherent risk and control risk belongs to management, and auditor will have no clue about that. Detection risk is whose risk? Detection risk is auditor's risk. When you combine all those three and multiply all those three, that forms part of audit risk. Auditor's objective is to reduce or lower the audit risk so that his opinion, when he is giving that opinion in the financial statements, his risk that he has given an inappropriate opinion is lower. Understood, sir? Okay. So they are applied when identifying and assessing risk of material misstatement, determining nature and timing extent of further procedures, and evaluating effect of uncorrected misstatements. So these 3 points important, sir. Please remember. Okay. So auditor's responsibility, SA 320. Auditor applies materiality concept in 3 stages. Please remember these 3. You don't have to by heart. Understand the process. Eventually you get the answer. Fine. But remember those 3 keywords: planning, performing, evaluating. These are the 3 stages. Now coming to the benchmarks for determining materiality. Sir, as we understand, materiality itself, the number itself, a benchmark for misstatements. That is why it is called a materiality. You will be giving 5% or 1% of particular line item or particular point where you feel that is significant for the company after assessing the entity and its environment as per SA 315 standards, sir. Okay. Now, let's say, right, a percentage is applied for a chosen benchmark: profit before tax or profit after tax, sales or customer acquisition cost, anything for that matter which is significant for the company. You will take that into account and you will apply a percentage, right? Benchmark selection involves lot of professional judgment. It varies to company, auditor to auditor, sir. You have to be very careful in determining what kind of benchmark you want to give, what kind of percentage you want to give, because that determines your whole lot of audit procedures and your audit opinion also, sir. Okay, right. So what are the factors affecting benchmark choice? Obviously the financial statements itself, the assets, liabilities, how the assets and liabilities ratios look like, how many current assets are there, how many total assets are there, what is the quick ratio, what is the current ratio. You will calculate various analytics. You will calculate the reserves and surplus, you will calculate the equity, what is the capital, how is the capital proportion be like, how many promoters are there, what is the expenses ratio, how many other expenses are there, what is the compensation, what is the auditor's expense. You will have calculate so many things, right? You will have calculate the contribution margin. So basically you will do entire analysis of financial statements. That is one. Second, items users intend to focus. For example, it's a manufacturing company or if it's a sports company, you have to see what are the elements that users are interested here. So it is not always for a latest AI technology company. Profit is not the point. Users are not interested about profit. How much revenue, how much new programs, what is the technological advancement, how much invested in the intangibles, what is the intangible property cost. Those are the things intended users are careful. So according to their interest, you should navigate your materiality to those items as well. That is second point. Third point, nature of entity, sir. Life cycle stage, industry, ownership structure, how it is financed. I told all in the final statement level only. You have to assess that also. If for example, the promoters ratio is just 0.4% and it is decreased every single quarter, you should understand why that promoter share is decreasing, why promoters are not interested in this company anymore, why every capital holding is belonging to either debt or shareholders who are outside public. Why? You have to calculate all of these things, sir. That is when professional judgment comes in, sir. Okay. And relative volatility of the benchmark. Okay. These are the few things you have to think while determining the benchmark of materiality. Okay, sir. Thank you.